Welcome back to Investing Talk Podcast.
Today we're looking at Nebius Group.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis of Nebius Group. This is a company that's positioning itself right at the center of two huge sectors, AI infrastructure and high-performance cloud computing.
Right. They're essentially selling the picks and shovels for the AI gold rush. Massive, massive compute power you need for these big AI models.
Exactly. They're a very specialized provider for that specific need.
And when we look at their recent growth, the word aggressive doesn't even begin to cover it.
Right.
We're seeing an acceleration that's, well, it's just extremely rare.
It really is.
Take Q3 of 2025. Nebius reported revenue that grew 355% year over year.
355. To nearly quadruple your revenue in 12 months is incredible on its own.
Yeah, but to do it when you're already a sizable public company, that's almost unprecedented.
And that Q3 performance, it just sets the stage for these massive forward expectations. Projections for the full year 2025 revenue are now over $590 million.
Which is what, a 400% jump year over year?
402%, yeah. An incredible jump.
And the market isn't expecting them to slow down either. Their guidance for fiscal year 2026 is pointing towards continued explosive expansion.
They're aiming for a revenue target nearing $1.9 billion.
So a threefold increase on top of a fourfold increase.
It clearly signals that big money believes the build-out phase for AI infrastructure is nowhere near its peak.
Right. But the question for you, the investor, has to be, why Nebius? Why aren't all these contracts just going to the big players like Amazon or Google?
And that brings us to their competitive moat. They've secured some critical validation from Tier 1 clients that, well, it locks in future revenue for years to come.
And the numbers here are, frankly, staggering.
This validation comes from the hyperscalers, the biggest cloud companies in the world. This is the most compelling part of the bull case for Nebius.
So let's detail these agreements, because they really are game-changing.
Absolutely. The anchor contract is a gargantuan $17.4 billion agreement with Microsoft.
$17.4 billion.
And that has the potential to increase to $19.4 billion as Microsoft scales up.
A potential $20 billion deal with one client. That's larger than the market cap of many established tech companies. Is there any precedent for that?
It's highly unusual. And that's exactly why the company's drawing so much attention.
Wow.
And remember, that's just one client. They also have a separate, very substantial $2.9 billion contract with Meta.
So we're not talking about pilot projects here. These are sticky, long-term revenue commitments.
Exactly. When a hyperscaler builds its core AI strategy on your infrastructure, the switching costs become astronomical. They can't just rip it out next quarter for a cheaper vendor.
And what's really interesting is that this massive scale isn't coming at the cost of efficiency.
That's often the trade-off, isn't it? Hypergrowth kills your margins. But not here.
So let's talk margins. Infrastructure is usually a low-margin business. What are they clocking in at?
Their operational efficiency is genuinely exceptional for the sector. Gross margins are sitting at 59.12%.
59%.
Right.
In a hardware-intensive business, that's impressive.
And their net margin is robust, too, at 31.43%.
That efficiency must be why they hit that big milestone in 2024.
It is. Their first full year of operating profitability, achieving a 7.5% operating margin. And their free cash flow is also strong, hitting a 20% margin.
So they're scaling, they've got the contracts, and they're converting it all into cash.
And they're not just selling hardware. They've built some really interesting technical moats using proprietary software.
Okay, let's get into that. You mentioned a sovereign AI moat.
Look,
What does GDPR plus compliance actually mean for their European clients?
it's a huge differentiator. The sovereign AI angle means they are reportedly the only EU-based vendor that offers full GDPR plus compliance.
So strict data privacy.
Strict data localization, data sovereignty, all while still giving U.S. clients the low-latency access they demand.
So a regulated European bank, for example, can use their AI compute without the data ever leaving the EU. That's a huge regulatory headache solved.
It's a massive advantage. And then there's their proprietary IP that makes their hardware work better. Take Nebius up to GPU, for example.
Right, the one that reduces idle time.
By 68%.
And how does that work? Is it better physical GPUs or is it software?
It's a software solution. It's a proprietary resource management layer that schedules AI tasks way more efficiently than standard tools.
So they're just squeezing more value, more profit out of the same expensive hardware stack.
Precisely. And they also have Nebius Flow.
Hmm.
It's an AI workload routing algorithm that reportedly reduces the client's cost per token by 22%.
So they're selling efficiency and compliance, not just racks of servers.
That's the moat.
Okay, that covers the tech. But you can't build a data center empire without capital. Let's talk about how they're funding this whole explosion.
They've definitely leaned in to aggressive capital deployment in 2025.
Hmm.
They raised a staggering $3.75 billion
$3.75 billion. How?
through convertible notes. But here's the really interesting part. They structured these notes with incredibly low coupon rates. We're talking 1 to 3%.
Wow. To get that kind of money with coupons that low, I mean, that's practically free financing. What does that tell you when institutions accept that kind of yield?
It tells you they expect massive upside in the equity. They're not in it for the 1% interest. They expect the stock to appreciate so much that the conversion makes them a huge profit. It's a highly bullish vote on the future stock price.
And that raise must give them incredible flexibility. How does the balance sheet look with all that new debt?
It's remarkably robust. Their current and quick ratios are at an exceptional 6.57. Very high liquidity.
And the debt to equity.
Still manageable at 85.4%. They have the resources to fund their 2026 plans without a doubt.
And we should also note they authorized a $100 million share buyback in Q1 2025.
Which is a strong signal that management thinks the stock is undervalued, even during this massive growth phase.
Okay, but we have to balance this. Let's talk about the price tag, the valuation.
The market is pricing in absolute perfection. The forward price-to-earnings ratio is, well, it's a massive 403.
403. Let's put that in context. To justify that kind of PE ratio, the market has to believe what?
It means investors are paying $403 today for every $1 of profit the company's projected to earn next year.
Compared to a mature tech company where that number might be, what, 20 or 30?
Exactly. This is the definition of pricing in perfection for years to come. It leaves zero room for error, no missed earnings, no delays.
Which brings us to the risks. You mentioned concentration risk earlier.
That's the big one. It's amplified by those huge contracts with Microsoft and Meta. If Microsoft, say, accelerates its own internal AI chip development and relies less on Nebius, it would have a material impact.
Right. They're tied to the decisions of two of their biggest clients who are, ironically, also their biggest competitors.
Precisely. And now for a specific yellow flag, something that popped up in September 2025. Insider sales.
How much are we talking?
A lot. The CEO and other executives sold shares totaling over $187 million.
$187 million
Yep.
cashed out. Just as the stock is hitting new highs, that creates a real conflict in the narrative, doesn't it?
It does. You have to balance that insider selling against confirmed institutional accumulation.
So the big money is buying while the insiders are selling.
That's right. Filings confirm BlackRock increased its stakes substantially. Orbis Investment Management is holding or adding. The smart money is leaning in.
So you have executives saying, this is a good time to sell, and huge funds saying, this is a good time to buy. That's the ultimate tug of war.
It is. Now, shifting to technicals for a moment, the momentum indicators look very favorable. Earlier in 2025, the stock confirmed the Golden Cross.
Okay, for those less familiar with charting, what does the Golden Cross technically signal?
It's generally seen as one of the strongest bullish technical signals. It's when the short-term 50-day moving average crosses above the long-term 200-day moving average.
And the stock has stayed above both since then.
It has, which confirms that sustained upward momentum. The bullish trend appears to be firmly in place.
Okay, so the technicals support the growth story. Let's focus on what's next. What are the key catalysts we're watching for in the next 3 months?
The single most critical event is the Q3 earnings release, which we expect around February 2026.
And what are investors looking for in that report?
They'll be scrutinizing how quickly revenue from those huge hyperscaler contracts is being recognized. And just as important, they'll be looking for continued margin expansion.
If they miss on profitability, that 4:3 PE ratio is going to look very, very fragile.
Extremely fragile.
What about secondary market catalysts? Anything that could drive flows?
There are two things on the calendar. First, the ETF index rebalancing around mid-December. If Nebius gets a higher weighting in major indexes, That forces passive funds to buy.
Guaranteed buying.
Exactly. And second, the institutional buying window typically opens in January. We could see a lot of fresh accumulation from funds positioning for the new year.
Okay, so that could fuel momentum into earnings. Now, let's wrap with the speculative side. What are the unconfirmed rumors floating around?
There are three prominent ones. The first involves potential large-scale M&A. The chatter suggests Nebius might be looking to acquire smaller companies to consolidate market share.
Which makes sense. If you have that low-cost capital from the convertible notes, you can use it to buy up your competition.
The second rumor is probably the most exciting for the long-term story. Speculation that they might unveil a new full-stack cloud AI platform in early 2026
So moving beyond just providing the infrastructure.
and challenging the hyperscalers directly on the application layer. It would be a huge leap in ambition.
And the third rumor.
Based on their profitability and free cash flow, there's speculation about shareholder returns. The rumor is they might start a regular dividend or a much larger buyback after the next strong earnings report.
So to summarize the whole thesis then, Nebius Group is a pure play on the AI infrastructure build-out. It's backed by strong fundamentals, huge contracts, and undeniable institutional conviction.
The story is incredibly compelling, but the execution risk is very real when the market has priced in so much future growth. How management executes on these upcoming earnings and how they deploy that $3.75 billion, that will define everything over the next year.
Indeed, it's a high-stakes, high-reward situation. The question you need to ask yourself is this. If they pull it off, will you regret sitting on the sidelines? If you want to keep up with companies like Nebius, make sure you subscribe to the podcast so you don't miss our next analysis.